Welcome, guys. A very warm good evening to all of you. So, I hope you have revised what was covered yesterday. Let's wait for a few minutes. Let's wait so that others can join as well. And then we will start with our today's session. Good evening, everyone. A very warm good evening to all of you. So, around half of the classes joined today. Probably students are just watching swearing in ceremony, I guess. But let's wait for more couple of minutes more. Let's wait for our class strength to rise and then we will start. By the way, those who are there, give me a thumbs up. Those who have joined the class, please give me a thumbs up in the chat box. Perfect. PW has joined, B has joined, Swapnil has joined, Tushar has joined, Bartlan sir has joined, GA has joined, KK has joined. Which topic was covered? So if you missed yesterday's session, we were discussing about fixed income securities. So if you're not able to get anything in between, just make sure that you have gone through the yesterday's session and then you revise today's session as well. And we would be good to go. Good evening, KA. So those who missed session yesterday, just make sure that you go through the recordings of today's session as well as yesterday's session after this session. No worries, Swapnil. So make sure that you go through the recordings. So yesterday we were discussing about how bonds actually function. We saw that how bonds are actually priced, and we also saw that price and value in case of fixed income security is nothing but same. Now, basically, how bonds are actually priced. What should be the price of the bond today? It depends on various factors. Number one is face value of the bond. Second one is coupon amount. which is coupon rate into face value. Third one is number of periods left. Fourth one is number of periods left for maturity. This is number of periods left for maturity. Fourth one is YTM, yield till maturity. So basically, let's say if there is a bond with face value 100, paying a coupon of 10 rupees, and this bond will be valid for 3 years period time. So what, and YTM is, let's say 12%. Coupon frequency for this bond is annual. This bond is paying you annual coupons. So coupon frequency is annual. It means that once per year. And you need to find the price of the bond. We need to find the price of the bond. To get the answer over here, we just need to understand one simple concept of time value of money, which you might have also studied in your 10th or 12th standard, or probably might be in 8th standard, that money changes its value with respect to time. So try to recall your classes about simple interest and compound interest in your childhood, where the present value is nothing but value of the money today. Take a pic, Urvashi, if possible, and let me know if you are done. Perfect, GA, you are correct. Okay, thank you. So value of the value of the money in today's terms. If I want to get the value of the money in today's terms, I will have to pull back the future cash flows. And my dear friends, discounted cash flow valuation also works with the same ideology, that if you have a future cash flow, or this is your future cash flow, and if you try to find the present value of those future cash flows, you will have to pull it back. And to pull it back, you are doing 1 plus r raised to n. So what is the formula for present value? Formula for present value is future value upon 1 plus r raised to n. Future value upon 1 plus r raised to n. Formula for present value is future value upon 1 plus r raised to n. What is this r? This r in case of bond is YTL, yield till maturity. R is rate of return, n is number of periods, future values are coupon rate and face value, and PV is present value. This is your present value. Future cash flows is coupon plus face value, 1 plus r raised to n. R is YTM, n is number of period or number of the year. Number of years. So based on this data, can you draw the cash flow timeline as it was taught yesterday? Based on this data, are you guys able to draw the cash flow timeline? Face value is 100, coupon rate is 10. Number of period left till maturity is 3 years. YTM is 12%, coupon frequency is annual. And you need to find out the price of the bond. If coupon amount is 10 rupees, What would be the coupon rate, guys? If coupon amount is 10 rupees, if you are getting 10 rupees in 100 rupees, can you see coupon rate is 10%? Correct? Shall I move ahead to draw the timeline? Let's try to draw the timeline. In year 0, this is your year, and these are your cash flows. In year 0, you will have to pay the price of the bond. And what are you going to receive in future? In year 1, you will be receiving 10 rupees. In year 2, you will be receiving 10 rupees. And in year 3, you will be receiving 10 plus 100, that is 110 rupees. So as an investor, you will be paying something as of today, and you will be getting future benefits of it. This is the price that you need to find out, that you will be paying today, and you will be getting the future benefits of the price that you have paid today. So these are the future benefits: 10 rupees, 10 rupees, and 110 rupees. Now, if you want to find the price of the bond, as I said, this is future value. This is 1 year from today. So future value after 1 year. This is future value after 2 years. And this is future value after 3 years. So it would be 1 plus rate. Rate is 12%, right? 12% was YTM to the power 1 plus 1 plus 12% to the power 2 plus 1 plus 12% to the power 3. Try to calculate the values of these 3 elements, add it and give me what is the value. Try to calculate the value of these 3 elements: 10 divided by 1.12, 10 divided by 1.12 square, and 110 divided by 1.12 cube. Everyone, please try this. Please try solving this. Are you guys trying this? Are you guys trying this? PJ, please try this. So what you need to do? 10 divided by 1.12. What is 10 divided by 1.12? Give me this value. 10 divided by 1.12, because 1 plus 12% is what? 1 plus 0.12, and 1 plus 0.1 is 12 is 1.12. 10 divided by 1.12. 10 divided by 1.12 square, and 110 divided by 1.12 cube. So what is this? 8.9. Correct, everyone? 8.928. Very good. Now calculate 1.12 square. What do you get value of 1.12 square? What is the value of 1.12 square? Tell me. Everyone, what is the value of 1.12 square? 1.24. Now divide 1.24 from 10. Is it 1.25? Let me check. So it's 1.2544. So be careful with decimals, guys. Yes, you can use calculator. Definitely, you should even, in fact, you should use calculator. It's not about you should use calculator in this. 1.2544. And even in the exams, you can use calculator. That is perfectly fine. 1.2544 divided by 10 divided by 1.2544. What is the value? 7.971, 7.971, or 972. how could, if you divide Dipti 10 with 1.25, how could you get 11.2? You would get a decreasing value, right? So it's 7.972. 10 divided by 1.2544, it's 7.972. Now do 1.12 cube, 1.12 to the power 3. So it would be 1.405. It's for 1.4049. So it's basically 1.405. 110 divided by 1.405 is 78.29. Everyone getting this? 78.29. Now add these three. Say, tell me what is the value that you are exactly getting. 78.29 plus 7.972 plus 8.928. 95.19. I think VM, you are making some mistake. Just make sure that you raise the power correctly. So if you will do 1.12 to the power 3, 24.31. Somewhere you are mistaken. Probably you have not taken 110 over here. That is why you are getting that answer. Make sure that you take 110 instead of just 10. Instead of just 10, make sure you are taking 110 over here. Correct, 95.1918. Very good. 95.19. Yes, VM, you need to take 110 because in the third year, with the final coupon, you are also getting the face value. With the final coupon, you are also getting the face value. So you need to take 10 plus 100, that is 110 divided by 1.12 to the power 3. 95.19 is what we are getting, right? Can we do this? Can we check this on Excel? Can we check this on Excel? Is the screen visible to you guys? Is the screen visible to you? Perfect. So to find the price of the bond, we will be using is equals to PV function. To find the price of the bond, we will be using is equals to PV function. Rate will be 12%. NPER is 3 years. PMT is 10 rupees. Face value is 100. And type is end of the period. Let's check what we get. It's 95.20. And when manually we calculated it, what value did we get? 91.1918. Approximately same. Correct. So this is the price of the bond that you need to pay today. This is the price of the bond that you need to pay today to get these future cash flows. Now, shall I give you one simple question very similar to this, and will you be able to do it yourself? Guys, do you guys want to try this yourself? Sure. So, face value is 1000. Coupon rate. No worries, SK. Make sure you solve this. And if you missed anything, just make sure you go through the recordings as well. Coupon rate is 18%. Coupon rate is 18%. Coupon frequency annual. Time to maturity 2 years, and YTM, that is yield to maturity, is 12%. Give me, calculate and give me the price of the bond. Calculate and give me the price of the bond. So I've started getting answers. Probably people are using Excel. That is perfectly fine. That is the ideal way to do it. But if you are not comfortable with Excel, try to use it with simple formula as well. That is also perfectly fine. So 1101.4 is one of the response that I have received. And I feel this answer is correct as well. But let's see. Let's wait for other responses as well. Let's see how many of you are able to do this. And GA, once you are done with this, 18% coupon rate and 12% YTM, check with 20% YTM and give me the answer. Try with 20% YTM and give me the answer. Fair enough. Okay. DK is correct. GA is correct. KA is correct. Waiting for more responses. Sorry, KA is not correct. KA, I think you have taken beginning of the period. That is why this might be a problem. You are getting 3-4 rupees up and down. But K 1120. BT, no, you are wrong. Probably a silly mistake, but still you are wrong. You are close though, BT. Sure. And rest of you, please try. Please try, guys. Please try. First draw cash flows and then discount it with the respective discount rate. By the way, what is the discount rate that you are going to use? What is the discount rate that you are going to use? 18% or 12%? No, you should be using 12%. I told you, right? The rate that we are going to use over there is 12%. So this should be the discount rate that you need to use. This is coupon rate. If coupon rate is 18%, guys, what is the coupon amount? If coupon rate is 18%, what is the coupon amount? 18% into 1000 gives you 180 rupees. Any doubt in this part? Does anyone has any doubt in this part? Has Shivam joined today? Shivam, have you joined today? This is YTM. This is what we are using in rate. This is to find the coupon amount. Let me draw the cash flows for you. This is year 0. Here you will be paying something. And from year 1, you will be started getting something. So what is that something that you will receive in year 1? You will be receiving 180 rupees coupon in year 1. And in year 2, you will be receiving 1180. 180 rupees coupon plus 1000 rupees face value. You will be dividing this with 1.12 square and you will be dividing this with 1.12. So what is 180 divided by 1.12? It's 160.71. And what is 1180 divided by 1.12 square? So ideally to find it, first find out what is 1.12 square. 1.12 into 1.12. It's 1.2544 divided by 1180. 1180 divided by 1.2544 gives you 940.68. That is around 940.7 rupees. So 160.71 plus 940.7 gives you 1101.4. 1101.4. And this is what the answer is. Everyone, how many of you didn't got the answer? It's perfect if you use run. If there is only decimal problem, then it is fine. Then it is perfectly fine. If you are close to the answer, 1 or 2 rupees, 1 rupees plus or minus, then also it is fine. It might be due to a approximation error. That is completely fine. But how many of you didn't got the answer? Okay, VT, I'll explain for you. PJ, what value, which of your value is not matching with mine? Sure, I will also show this in Excel, but it is also important for you to know that how Excel is actually calculating it. K is saying all values are getting matched. VT, PJ, SK, VM. Anyone else who are facing the challenge of not getting the answer? How am I deriving 1.12? How am I deriving 1.12? Coming to that, just give me a second. What is the formula? Formula for present value is future value upon 1 plus r raised to n, correct? Yes, we will be coming to Excel part, don't worry. But what is the formula? The formula is 1 plus r raised to n. Some of you are asking where this 1.12 is coming from. 1 plus 12%. What is 12? What is percentage? Percentage is nothing but number divided by 100. Percentage is nothing but number divided by 100. So 12% is nothing but 0.12. 12 divided by 100 would be 0.12. So 1 plus 0.12 will give you 1.12. This is called, this process is actually called creating factor. This process is called creating factor. So 1.12 is nothing but factor of 12%. It's just basically changing percentage into absolute measure. Changing percentage into absolute measure. 12% is 0.12. 1 plus 0.12 is 1.12. Anyone has doubt where this 1.12 is coming from now? Does anyone still has doubt? Who asked me about this? PJ, you asked me, right? Perfect. Now you are clear. So this would be 1.12 to the power 1 because n is 1 for the first year. And it would be 1.12 to the power 2 because this is 2 for the second year. N is 2 for the second year. Now simply you need to be good with using calculator. First, compute what is 1.12 to the power 1. It would be 1.12 only. Then compute 1.12 to the power 2. You would get 1.2544. How many of you are not getting 1.2544? Please raise your hands. How many of you are not getting 1.2544? Nikamni is saying she is not getting 1.2544. Just multiply 1.12 into 1.12 or else you will get a formula 1.12. There would be something like this would appear in your mobile calculator. Use that and put 2. You will get 1.2544. Try that and let me know. Try that and let me know. And if you are getting this, allow me to move ahead. If every one of you are getting this, please allow me to move ahead. It is not 1.12 multiply by 2, it is to the power 2. These two are different things, guys. It is not 1.12 multiply by 2, it is to the power 2. It's not percent into 2. You should, what is 1.12 square? 1.12 square is 1.12 into 1.12. It is not 12% into 2. It is not 1.12 into 2. There is no 2 over here. It is power 2. Power to the power. This is something that was covered in 6th class, guys. Please remember that. Don't forget the basics. Sure. Coming to the Excel part. Coming to the Excel part of the calculation. Let's say I am showing the same calculation on Excel. Let's say this is year 0, 1, and 2. The time to maturity is 2 years. I want to find the price over in this year. To find the price in this year, I will have to get the cash flows. So what is the coupon? Coupon rate is 18%. Face value is 1000. So what would be the coupon amount? Will I receive coupon amount in year 0? No, I will be receiving coupon amount in year 1. So 18% into face value, I will get coupon for the first year. Same would be the coupon for the next year. But in year 2, I will receive something else as well. I will be receiving face value as well. So what is my cash flows for the year 2? 180 plus 1000. It's 1180. It's basically 1180. Now, what is the cash flows for year 1? It's 180. So these are my cash flows. These are my cash flows, and more specifically, these are my future cash flows. Anyone has doubt in this? Anyone has doubt in this part where these future cash flows are actually calculated? Where this is coming from? Everyone clear with this? Everyone? These are my future cash flows. Now, these are my FV. I want to get 1 plus R raised to N. So R is rate is 12%. Rate is 12%. So FV divided by 1 plus R to the power N. This is N, year 1. Year 1 means 1. Similarly, it would be FV divided by 1 plus R raised to N. So this is 940. What is 160 plus 940? Is equals to this plus this gives me 1101.4. 1101.4. So it's basically very simple, guys. You just need to forecast the future cash flows. You need to discount it at a discount rate and get the sum to calculate the present value. So this is nothing but price of the bond. This is nothing but price of the bond in today's terms. So this is what you need to pay today to get 180, 182 times in the next 2 years. And 1180, that is in the second year. So 1000 is face value, you will receive this in second year. 180 is the coupon rate that you will be receiving in next 2 years. So everyone clear with this? Everyone, are you guys clear with this? Perfect. Now I have to make a small point over here, although a small but a very important point. Nikamni, are you clear with this? Nikamni, are you clear with this? Just show the rate formula. It's basically present value is equals to future value upon 1 plus rate to the power n, and you want to find that how this is calculated, how 1 plus r is calculated. So let's say Nikamni, please be there with me. Please be interactive in the chat box so that I can know whether you are understanding it or not. Let's say rate is 10%. So what is 10% in absolute terms? It's basically 0.1. If rate is 8%, where is this 0.1 is coming from? 10 divided by 100. Let's say it's 8%. It's basically 8 divided by 100. And 8 divided by 100 will give you 0.08. Let's say if it's 6%, it would be 6 divided by 100. It would be 0.06. And if it's 60%, it would be 60 divided by 100. It's basically 0.6. Now, if let's say we have taken 10% over here. So what we need to do is 1 plus 0.1 will be 1.1. 1 plus 0.08 will be 1.08. 1 plus 0.06 will be 1.06. 1 plus 0.6 would be 1.6. And that's all. This is how you calculate rate. The reason why you might be getting that in negative PJ is because it is a cash outflow. The Excel is correctly showing it in negative sign because it is a cash outflow. It should be represented in negative sign. Yeah. Are you clear with this, Nikamni? Yes, that is perfectly fine. That is perfectly fine, PJ. Perfect. So let's move ahead. Now, coupon rate, guys. Coupon rate is what bond is paying us. Coupon rate is what bond is paying us. Correct? YTM is what I need from the bond. YTM is what I need from the bond. Now, whether if coupon rate is greater than YTM and if coupon rate is less than YTM, there is a bond A which has coupon rate greater than YTM, and then there is a bond B which has coupon rate less than YTM. Which bond is better for me? Which bond would you like to invest in? Which bond is of a premium quality? Coupon rate is what bond gives. YTM is what I want. I want 12%. Bond is giving me 18%. Don't you think it is better? It is a better bond compared to I want 18%, but bond is giving me 12%. I want 18%. I want 18 rupees from you, but you are giving me 12 rupees. So that is a red flag, right? I want 18% from the bond, but bond is giving me 12%. This is a bad bond or a poor quality bond. This is a good bond, a premium quality bond. A premium quality bond will be traded at a premium price. I am coming to what is premium price. A bad quality bond
will be trading at a discounted price. So always remember, you you have you might have experienced, right? Something which is of not a better quality is discounted. So a bad quality bond is will be trading at a discounted price. Like now I am coming to this. What does this premium price and discounted price mean? If the price of the bond is greater than its face value, it is said that bond is trading at a premium. If the price of the bond is greater than its face value, sure, yeah. But I hope everything is fine. AR is saying that he had to move to a police station for an emergency, but I hope everything is fine, right? Don't scare me like this. Price is greater than face value. If the price of the bond is greater than face value, it is been traded at premium. If price is less than face value, it is being traded at discount. Example, face value is 1000 and bond is trading at 1250. Bond is trading at premium. If face value is 1000, bond is trading at 850. Bond is trading at a discount. Which bond will trade at a premium? Which will a bond that gives you more than that you have asked for. A bond that gives you more than that you have asked for. So a bond with a coupon rate greater than YTM will trade at a premium. A bond with a coupon rate less than YTM will trade at a discount. Tell me, everyone clear with this? Tell me, everyone clear with this? Okay. SK is saying getting confused between coupon rate and YTM. I will come to that. I will come to that. Actually, that is something, the difference is actually something that is discussed in the later part. But still, if you wish, let me just define coupon rate and YTM for you. Coupon rate is basically the percentage of face value bond pays every year, and YTM is the total return that you generated from the bond. For example, SK, if the bond is priced at 900, price of the bond is 900, and future value is, or face value is 1000. Coupon rate is 10%. YTM is 12%. So this is again a hypothetical example. NPER is 3 years. Any one of you, please give me the actual price of the bond. Any one of you, please give me the actual, what would be the actual price of the bond? $951.96, right? Correct. Thanks, GA. So 951.96 is the actual price of the bond. Now tell me, consider this, SK. Please pay 100% attention over here if you want to understand the best difference between coupon rate and YTM. 10% is the return generated from coupon rate. It means that out of face value of 1000, every year, you will be generating 10% of it, that is 100 rupees. But is that the only return to you? No, that is not the only return to you. You have also made the return by buying something as 951 and selling something at 1000. So basically redeeming it at 1000. You bought it at 951 and you got 1000 for it. So with the coupon return, you also enjoyed this appreciation, right? But the coupon rate only incorporates the return generated through coupon payments. But this YTM also incorporates this extra 2%, which has been generated from capital appreciation. That is basically the difference between YTM and coupon rate. Now, are you clear with this, SK? SK, are you clear with this? Coupon only incorporates this 100 divided by 1000. That was 10%. But is this the only return? No. You have also bought something worth 950, 951, and you got 1000 on behalf of it. So this profit of 49 rupees is not incorporated in coupon rate. So there should be a measure which incorporates this, and that 49 rupees profit along with the return on coupon payments is incorporated in YTM. Are you clear with this, SK? Everyone clear with this? Especially SKU, waiting for your response. After calculating coupon rate, we are 49 is not percent, 49 is 49 rupees over here. So 951 worth of thing, you sold it for 1000. So you bought it at 941, 951, and you got 1000 for it. So 49 rupees is the profit. All these things are actually been given in the bond indenture. So when you are going to get the bond, everything, even the YTM, coupon rate, face value, is something that is already been given to you. If one of those things are missing, you can calculate it. You can calculate it with the logic that was provided, that is FV upon 1 plus R raised to N is equals to PV. So if you want to find the price of the bond, number of period left for maturity will also be given. And if you want to find the price of the bond, you can calculate it using this formula. So everything will be provided in the bond indenture. Don't worry. Okay. Now, what are some of the characteristics of fixed income securities? So in second year, Soumya, I don't know why you are confused. In second year, it's simple. Basically, you will also receive the coupon rate, plus you will receive the face value. Face value was 1000. That is why we mentioned 1000 over here. And what is 1000 plus 180? 1180. This is second year cash flow. Now, why would, think from a corporate point of view, why would a corporate raise debt? Why would a corporate raise debt? TG, you had a question about what? So YTM is greater than coupon rate. I am getting 2% return in this scenario. So actually you are getting 12% return. The combined return of coupon rate along with the capital appreciation is 12%. That is what you should think of. TG, comfortable? Okay. Now, why would a corporate raise debt? Why would a corporate issue bond? Think of this. Okay. So, Bartlan sir, it would be a long-term source of capital. Okay. Debt is a source of capital, agreed to you. Why company issue equity when debt is cheap? Okay. Because company actually wants to share the risk with the other stakeholders, other shareholders. That is why company issue equity when debt is cheap. There is no legal obligation to pay back equity, right? So that is why company issue equity. Well, ownership of the company does not get diluted. Ownership does not get diluted. Yes, to leverage the capital structure, it would be a leverage is nothing but taking debt and taking higher risk. So it would be something that would be a fancy word, and people would unnecessarily get confused. Although I agree to you, GA. Yes, fundraising. To maintain the certainty of cash flows. Why certainty of cash flows? Because future obligations are known. Debt is a cheaper source of capital. So if you are going to raise equity, there is cost of equity. Yes, correct, GA. Debt is a cheaper source of capital. So if you are raising debt, you are paying cost of debt, that is interest cost. And when you are raising equity, you are expected to perform as per the cost of equity. And cost of equity for a given company is always higher than cost of debt. So debt is a cheaper source of capital. But Wall Nifty company do well, sir, and gave 25% like HDFC. Miss company management. No, we good in the market. I am sorry, with WS, but but Wall Nifty company do well, sir, and give about 25% return. Kotak Bank. Okay, why? But all Nifty companies do well and give about 25% return, like HDFC Bank and Kotak Bank, means company management no be good in the market. So how? Yeah, I agree with you that it may give you better returns. For few years, it may not give you better returns as well, but how that is connected to debt or equity? Please elaborate your concern, WS, so that I can help you out. Now, also for tax savings. Also, debt helps corporates to save taxes because interest is a tax deductible expense. WS waiting for your response on this. Why company issue equity debt is cheap? Company issue equity because company, when they were in early stages, wanted funds, and they were not in a position, they were not that well established as a brand that everyone would give them funds. Yes, today in today's terms, Kotak Bank and HDFC Bank would be performing very much great, but no one was expecting them to perform great. And when it comes to banks or any of the Nifty companies, they have been in the top 50 over the years. Many of the companies were in top 50 and they moved out of top 50. So when does corporate issue debt, and when does you will lend a debt to a corporate? When you will feel that the company is established. But when the company is new, equity is the source of finance. I will tell you why equity is the source of finance. Let's suppose there is a corporate. Great. So we have our deputy manager of Kotak Bank here with us. He would be giving us insights that how it actually works. So let's suppose there is a corporate, a new corporate, a new company basically, who can issue equity as well as debt. As an investor, where will you invest? Whether you will invest in debt or whether you will invest in equity. As an investor, as a logical investor, I will always choose equity over debt for a new company. Again, I'm saying for a new company, because chances of it succeeding, the probability of succeeding is less for a new company, for an early stage company. The probability of succeeding is less. And if I'm taking this higher risk over here and I invest in debt, I will have cap to my returns. My returns will be capped. It means that there is limit to the maximum returns that I can receive. But in equity, there is no limit. And since I am assuming the risk, I would always go with the equity financing, right? Why would I go with the debt financing? So not that well established company face it difficult to raise debt. Example of Asian Paints given 20 years, 500% return. So instead of giving shareholder, why company didn't acquire wealth for self, means return and profit only for company. Many companies, example like Wipro shares, Infosys shares. Yes, they did, but also this is something that is a very gray area, because there would have been an AGM meeting and people would have wanted dividend from them. So they could not acquire wealth. It is not in one person hand to make sure that the company won't pay dividend or it will retain all its profits. So these are very subjective terms and it is decided based on majority. So in AGM, annual general meetings of the company, it would have been decided that they should pay dividend to their shareholders. And also, if a company does not pay dividend to its shareholders and does not pay back their shareholders in terms of returns, they actually faces difficulties. It is so while evaluating that company, it would be a red flag for the company. So both equity and debt had their own set of advantages and disadvantages. You would be more clear with this when we are moving forward with the subject. So give me some time. And if still you're not clear, we would be happy to discuss more on that in the last part of the discussion. But still, I hope you are getting some of the clarity on your doubt. WS. If not, please let me know if you want me to comment on some specific scenario. So what WS is asking actually, guys, that why when company issue equity, it has to share their net income with other shareholders of the company as well, the new shares that the company will be issuing. In case of debt, in case of debt, only the company needs to pay an interest cost. So why does company not issue only debt and they restrict themselves from issuing equity? Logically, he is actually on the point, but the question is coming with equity. When you are raising equity, you are basically transferring your risk to other stakeholders or other shareholders. But when you are taking debt, you are actually taking more risk, because even though your project may succeed or it may not succeed, you will have to pay to the stakeholders, that is debt holders. If your project may succeed or not succeed, you will still have to pay to the debt holders. Yes, that is correct. Means promoters know we big company after 10 years. Then instead of that, no one knows whether they are going to be a big company or not. No one knows whether they are going to be successful or not. And even though the promoter might know, how would they make anyone believe? They would have tried to get debt, but they might have not been successful in issuing them. And there are various other things as well. Coming up with an IPO increases their net worth, and all these things helps them to get more money inside. So that is why equity is a better source of financing. You can sell equity securities at a better rate. So all these things, because of all these things, Wasim, sorry, WS, debt is a preferable source of finance. Yeah, what about Zomato? Zomato went for issuing equity. Yes, startup ventures mostly prefer, and anyone who would invest in startup would always prefer to invest in their equity side of financing rather than debt side of financing. Now, as an investor, What about Zomato WS? As an investor, why would you invest in debt securities? As an investor, why would you invest in debt securities? First, to get regular income. Second, to get stable returns. Yes, Zomato has issued shares. Zomato has issued shares and they have came up with an IPO recently. The IPO of Zomato is listed in the stock market. No, you are wrong about it, WS. I'm sorry to say, but you are not well updated about it. Zomato has issued shares. They had came up with an IPO and issued equity shares. And now it's, yeah, it is working perfectly fine. So WS, I think there is some sort of a confusion that you are not able to explain on the chat box. Is perfectly fine. If you want to have some discussion over it, we can have a one-to-one session on this. So that is so coming back to debt securities. As an investor, why would you invest in a debt security? To get a stable source of return. And stable source of return means less risk. Third, some of the debt securities like government securities, treasury bills, etc., are backed by government, and anyone can default, but a government of a nation with its ability to print more currency can't default. Although there are chances that they could default as well, but a strong government won't default. Are backed by, so debt securities are backed by government and has low chances of default. We have various options. No, bond is a debt instrument and equity is used for equity financing. That is, when you are getting equity, you are sharing ownership structure with the investor. And when you are getting bond, you are taking just it as a liability. So that is the difference, Soumya. Debt securities are liquid in nature. And that is the major reasons due to which an investor would invest in debt securities. Now the question is, who all issues debt securities? Who are the people or institution who issues debt securities? So issuers, the one who issues the debt securities are called issuers. And who are these issuers? It could be central government. Who could issue debt security? It could be state government, public bodies like institutions or government in this government institution, yes, NBFCs as well, like NHAI. So if let's suppose that National Highway Authority of India wants to build roads and they don't have funds for it. So what they could do, they could issue bonds, collect debt from the people. By collecting that debt, they will build that roads and highways. They would collect toll and pay back for that debt. This is what they can do. So government institution can also raise debt. Corporates can raise debt. Banks and NBFCs, non-banking financial corporations, can raise debt as well. Many companies issue shares. So WS, about shares buyback and all those things, it is something related to cash equities. So when we will be seeing cash equities, we will see that what are share repurchases, what are share buybacks. But please try to understand, if I include all of those things over here, it would burden those people. I'm glad that you are aware about those concepts. Yes, both private and government banks. Uh, Please try to understand, if I just bring out and throw out the concepts of buyback and share repurchases, stock splits over here, people might unnecessarily get confused and it will create a chaos. So let's discuss it when we will come to it. Okay. Now, when we compare equity securities with fixed income securities, how would you distinguish? How would you distinguish an equity security with a fixed income security? Based on types of securities that are traded. Okay, based on risk, it has higher risk, it has comparatively lower risk. Equity markets of some nation are better developed than debt markets. Yes, equity get the last preference in ownership. It means that when the company is liquidated, when second point you didn't get, equity markets are well developed. If I ask, there are around 100 students in the class. If I ask them that how many of you invest in equity, there would be a more number of people, probably 40, 50, 60 people who would be saying that they invested in equity. But if I ask them how many of you invest in bonds, probably hardly two or three people, or even not two or three people. Is there anyone who invests in bonds? WS, actually, we are not allowed to share personal details. You can. GA is saying invested in SGB and RK is saying had invested in past. So around two people invests in bonds. So equity markets are better developed than debt markets of developing nations. LIC is insurance. LIC is not investment. Returns, yes. Returns are higher in equity and returns are lower in fixed income. Now, equity has last preference. Yes, debt securities are liability for the issuers. Equity securities are part of equity reserves. Equity securities that are issued are part of equity and not liability. Actually, equity is a part of liability, so it would belong in equity section. But debt securities are liability for the issuer. Debt securities get a better preference in ownership. So let's say that you are running a business and unfortunately your business flopped. You have to sell all the assets and pay back the money that you have taken from. So there are various websites. Even I have never tried to trade in bonds, but when you will search on Google, I don't think it is a big deal. Uh, when you will search on Google to invest in bonds, there would be various websites. Even Paytm Money is a website where I had seen while browsing through it that they offer bonds. So through Paytm Money, you can also invest in bonds. So when the business is liquidated, it means that all assets are sold. First of all, debt holders will be paid off. Then preference shareholders will be paid off. And then equity holders will be paid off. Because PJ is asking, if bonds are way less risky, then why do we prefer equity? Yeah, we need stable income. That is one of the reason. But why do we prefer equity is because it depends on the risk profile of an individual. If I want more returns, equity is not sufficient enough to give me better returns as compared to, bond is not sufficient or debt is not sufficient enough to give me better returns as compared to equity. So that is why I prefer more risk and more returns. That is why I would invest or prefer equity over debt. Okay, PJ? So highlighting what PJ said, the goals of equity investor is high risk, high return. The goal of debt investor is capital preservation. Okay. Now coming to types of bonds. Example of equity bond. The equity is a different thing and bond is a different thing. There is, yes, bonds are convertible as well. We are coming to types of bonds. We will be see what are the different types of bonds. But example of equity bond, there is no equity bond, Kriti. Equity is a source of equity financing through shares. Shares. So I guess you are asking for example of equity securities. Shares are equity securities. So when you buy Reliance shares, you are investing in equity. And when you are buying bonds, there are bonds issued by different individuals or different investors. Sorry, different issuers. We will see who are the people who generally issues bonds and what are those bond called. So examples of equity is the one of the most basic example is share. Okay, Kriti. In Zerodha, it's providing trade. What is SIP? SIP is something that we will see in the next module about mutual funds. So SIP is nothing but systematic investment plan. Where you are contributing some amount every year on a pool of assets. So don't worry, we are going to see this. Actually, everything is interconnected. That's why you guys are so curious. But I will make sure that we cover everything that you should know to ace the market. Management worry about debt and not about very much as equity, tension-free equity money. Yes, that is one of the reason. uh, Zerodha, it's providing to trade on government bonds and what returns they are offering. Can you please explain with live example? I don't have a Zerodha account actually, but still I will try to find a bond that gives and try to explain the practical aspects of it. But let me just get done with this part at least. This is something that we will keep for the last part of the discussion. So let me just get done with the curriculum and then we will try to find a bond and evaluate that how practically can one invest in a bond. So yesterday someone asked what are money market instruments. So coming to that, I think Rohit asked me what is money market instruments. So when we talk about financial markets, financial markets are basically categorized into two types. Capital market and money market. Actually, it is also categorized based on primary market and secondary market, but that is something we will see later on. My known person has a retail company from last 10 years. He wants to go for an IPO. What he should do, sir? So WS, it's not really easy to go for an IPO. There are various norms. Even a company like Oyo tried to file their DRHP, that is detailed red herring prospectus, many times, but it was rejected by SEBI. So if a company like Oyo is not able to come up with an IPO, probably the person you might know could come up with an IPO. I'm not neglecting the fact, but that is something he will have to. Yes, there are many consultants who can help him to come up with an IPO. And there are many analysts as well as investment banker, merchant bankers as well. So if he is running such a company, he might be definitely in touch with venture capitalists, investment bankers, and merchant bankers, they will help him out to come up with an IPO. Okay. Okay. So someone has joined from the HP laptop and they are saying that they are IPO consultant. Okay. And WS is searching for an IPO consultant. Okay. Great. Capital markets. Okay. So HP is saying he is working in. So I don't know who is it. I am coming to types of bonds, guys. Please don't deviate from the topic. Please, let's be right back from the topic to the topic. We are covering types of bonds under capital markets and money markets. We are not skipping anything. So capital markets are those. Capital market is a market where the securities with maturity greater than 1 year is being traded. On the other hand, money market is a market in which the securities with less than 1 year or short-term securities are generally being traded or issued. On the other hand, I was saying something about types of financial market based on primary market or secondary market. Primary market is the market where the securities are issued for the first time. And secondary market is the market where the securities are traded. What I mean by that is if I am a corporate and I have issued bonds and if I want to issue bonds for the first time, and if I am the corporate and I am issuing bonds, I will be issuing in primary market. But and those who subscribe to this bond will get the allotment for the bonds. Those who subscribe for these bonds will get the allotment for the bonds. But if the participants, those who have got the allotment, wants to sell it to someone else, they will have to sell it in the secondary market. So in secondary market, shares are traded between the participants, and in primary market, the one who subscribed to the issue will get the allotment. So that is the difference between primary market and secondary market. Nevertheless, coming to the capital markets, they are generally with greater than 1 year maturity. And someone was telling about money market. And after this, we are going to see what are the different types of bonds. So there is commercial papers. Commercial papers are basically issued by corporates to get financing for very short term. If I want financing for 90 days or 180 days, basically less than 1 year, a corporate will issue commercial paper. Will commercial paper pay coupon in between? No. So how will the investor of the commercial paper get return? So let's say face value is 1000. So the commercial paper will be issued at 960. And in between, there won't be any interest paid. So commercial paper issued at 960 can be redeemed at 1000. So there would be a capital appreciation of 40 rupees, and that is the only source of return for commercial papers. Same goes with treasury bills. Treasury bills are very similar to commercial papers, but the only difference is treasury bills are issued by government. Then there is short-term bonds with 1 to 5 years maturity. There are medium-term bonds with 5 to 12 years of maturity, and then there are long-term bonds with greater than 12 years of maturity. Now, bond can be zero coupon bond. It means that a bond issued for, let's say, 3 years, but does not pay any coupon in between. Now you would wonder, why would anyone invest in such a bond which does not pay anyone any coupon in between? So to answer that, zero coupon bond is also called as deep discount bonds. Why deep discount bonds? Because the return component is contributed by the discount that this bond gives. Now, what is this? Let's say in 3 years, you have invested in zero coupon bond. On the other hand, if you would have invested in a bond with coupon rate of 20%. So, and YTM of, yes, don't worry. That was something that was already covered. That is why we were going like this. Don't worry. YTM is 25%. So if a bond, this is bond A, this is bond B. This is bond A, this is bond B. If bond A is being traded at 900 rupees, bond A will trade at a very deep discount, that is probably 450 or 400, compensating for the coupon that it does not pay. So what is zero coupon bond? It would not pay any coupon in between. So this is a 3-year bond. In these 3 years, no coupon will be paid, but it is been issued at very low price, 400, and then it would be redeemed at par, that is 1000. So the capital appreciation over here is the source of return. Everyone clear with zero coupon bond? Khushbu, are you clear with this? Perfect. So Khushbu, a zero coupon bond is basically a bond that does not pay any coupon in between. So let's say if this bond is for 8 years, it won't pay any coupon in between. And if it won't pay any coupon in between, how would the investor generate return? Tell me, how would you generate return investing in a zero coupon bond? By simply buying it at a very cheap price. And by cheap price, I mean by simply buying it at a great discount. So if you buy it at 400 and sell it at 1000, even though it does not pay any coupon in between, you have still gained 600 rupees, right? So that is the source of return, Khushbu, over here. Any doubt, please let me know. Straight bond is basically a bond which pays period. Then there is second one is straight bond. Basically a bond which pays periodic coupon in between. Then third one is floating rate bond. It depends on the credit rating of the issuer, and there is no maximum or minimum return to be understood over here. The higher the credit rating, the lower the return that the investor is expected to get. Floating rate bond. Now let me introduce you first of all to the concept of floating rates. Once we understand this, PJ, we will, this is not something about strong bond. This is somewhat different from it. Yes, rates are fluctuating. That is correct. Floating rate bonds. And with this, I am also going to cover swaps, as I said, that is interest rate swaps. Okay. So there is a fixed rate bond which would pay you a fixed coupon of, let's say, 10%. On the other hand, there could be a floating rate bond which does not pay a fixed coupon but a variable coupon. For example, the variable coupon could be inflation plus 2%. So there is a bond. If 6% is the inflation, it gives you 8% coupon. If 10% is the inflation, it gives you 12% coupon. If 6%, if 4% is the inflation, it gives you 6% coupon. So this bond, which pays coupon or yield based on a floating rate, give me a second, guys. Let me take a sip of water and I'll be right back. So that is about floating rate. So everyone comfortable? First of all, what is floating rate? Then let us try to understand interest rate. Sir, can we not have break today and continue till around 8:30 as there is India versus Pakistan match today? Although I wish the same RK, but that is not practically possible. We are in a professional environment to work with, so that is not practically that I can do from my end. I'm really sorry about it. Floating rate bonds. So floating rate bonds are those bonds that pay coupon or yield with respect to a specific benchmark. That specific benchmark can be inflation. That specific benchmark can be interbank rates or any market reference rate. What is market reference rate? The interest rate that is prevailing in market. So let's say if, okay, I'll come to floating rate as well. Don't worry, SK, I'll cover that. And eventually you will understand it through the example that we are going to cover about interest rate swaps. When there is interest rate swaps, there is a fixed rate. A is giving fixed rate to B and B is giving floating rate to A. Fixed rate is paid by A to B and B is giving floating rate to A. Let's say notional principal. It means that imaginary principal is 100 million. And fixed rate was 8%. Floating rate was inflation plus 3%. Floating rate was inflation plus 3%. Now, when the finance ministry came up with the inflation figures, inflation was announced to be 3%. It means that B will be paying A in this case. In case A, B will be paying A 6% and B will be receiving 8%. Who won? B won or A won? Who is the winner over here? B will be receiving 8% and paying 6%, basically winner for 2%. So this 2% on notional principal of 100 million, 2 million will be paid by A to B. 2 million will be paid by A to B. If after 6 months, the inflation figure is announced to be 10%. Now, 10% plus 3%, 13% is what B need to pay A. 13% is what B need to pay A and A pays B 8%. So basically, AR, B is paying a floating rate. Floating rate means the rate which is not fixed. This rate is dependent. Dependent on what? Dependent on inflation. In case AR, the inflation rate was 3%. So what is the cost for B? Cost for B is 6%. Why 6%? 3% plus 3% is 6%. You are paying 6% and receiving 8%. You have a net benefit of 2%. Since you are paying 6%, you are paying 6 rupees and receiving 8 rupees. You have a net benefit of 2 rupees. Swaps is already an abbreviated word. There is no full form. Swaps is the common word that is used. There is no full form for swaps. What is the full form for exchange or money? It is just a word. There is no full form for swaps. Why A give money to B? Because they have agreed to share a fixed rate, right? They have agreed to bet on interest rates. They have agreed to sign a contract that I will be paying you fixed and you will be paying me floating. That is why A is giving money to B and B is giving money to A. So here it is a netting off feature. The one who wins gets the return amount on the notional principal. AR, are you comfortable till this? Till the first part at least? Now, if the inflation is 10%, there are other factors as well. It may also, there are market reference rate that it can be linked with. Notional principal is this imaginary principal. So this 100 million is neither paid by A nor by B. Notional principal is imaginary principal. So on an imaginary principal of what's the floating rate B is giving to A. If the interest rate is 10%, floating rate is 13%. If the interest rate is 3%, floating rate is 6%. So whatever may be the inflation, 3% adding to it would be the floating rate amount, would be the floating rate percentage, 3% inflation plus 3%. That is what the floating rate is. Comfortable, Susan? Susan, are you comfortable? Okay. Now, this floating rate can not only be linked to inflation, it can be linked to LIBOR, that is London Interbank Overnight Rate. No, again, guys, 3% is not fixed in every contract. That is so obvious. It would be negotiated between the two parties. As I said, swaps is an OTC contract. It would be negotiated between the two parties that whether it would be plus 3%, 2.5%, 2%, 1%, 9%, 10%, everything will be negotiated over there. And what would be the parameter based on that? It would be fixed, whether it would be inflation, whether it would be London Interbank Overnight Rate, whether it would be the yield on treasury bills, whether it would be yield on other government securities, everything will be determined. So it's not that only inflation could be a factor. It could be any factor. Like yes, SOFR is something that is introduced replacing LIBOR, since LIBOR was subject to manipulation. But again, that is something which is very different thing. Yield on GSEC is something that is yield on government securities. That is something can be taken as a market reference rate. So the floating rate would be based on market reference rate plus a constant percentage, that is 3%, 4% on any of the negotiated percentage. So if it is based on inflation, if that is based on inflation, it would be called an inflation index bonds. Inflation indexed bonds. Okay. Then coming to the next part, there is junk bonds. Junk bonds, someone asked me, right, that what is the maximum return a bond can give. So there could be bond that might give you 30% return or 40% return or 42% return. But the credit quality of that bond will be poor. Now, how many of you believe that there is no risk in investing in bonds or there is no risk in investing in debt? How many of you believe that there is ultimately zero risk in investing in debt? Please comment in the chat box. What if you have lent money to to a company like Reliance Power and that company has collapsed? Will Reliance Power will be able to pay back your debt? Will Reliance Power will be able to pay back your debt if you have given debt to a corporation, a company like Kingfisher, and that company collapsed? Will Kingfisher will be able to pay back your debt? They won't be able to pay back your debt. And if they won't pay back coupon or face value, at maturity, they are not be able to pay back the debt that they have raised from you, that is also a risk, and that is called default risk. It comes with a low risk, correct, but risk is not zero. Bond is exposed to default risk, and not only default risk, there are other risks as well. There is liquidity risk as well, whether you will be able to sell that bond to someone else or not. All those things are there, but here we are talking about default risk. Default risk is that once you have taken the bond, probably the company might not be able to serve you with coupon or principal amount. What you would do then? What you would do then in that case? You will lodge a complaint. You will file a complaint, but the company has collapsed, my friend, and a business is a separate entity from its owner. The business or the corporation that raised that particular bond might not pay you debt. They will fight the case. You will fight the case, but will you get your money back? Probably yes, probably no. So that is risk, right? That is your default risk. And junk bonds are those bonds that pay a very good return, a very high return, but comes with a higher probability of default. They come with a higher probability of default. It means that there are high chances that if you invest in such kind of a bond, you may not get the coupon as well as face value. But if you still want to get being driven through greed, if you still want to invest in a bond, there are options like junk bond in which you can invest. Perfect. Then there is something called as convertible bond. There is something called as convertible bond. So let's say when I asked you in a startup where you will invest in equity or will invest in debt, and most of you said with the logic that you are going to invest in equity, but convertible bonds give you a better option than equity. Question is how the convertible bond gives you a better option than equity. So let's say you are running a startup which was incorporated in 2014. In 2018, there could be two scenarios. Either the startup may succeed or either the startup may fail. Since you have invested in, let's say, MNC is the MNC corporation. Let's say MNC corporation is the name of the company. You have invested in it through convertible bonds. So what would happen is if in 2018 the startup succeeds, you will convert these bonds into equity shares. On the other hand, let's say if that is not the case, if the startup failed, startup will sell its assets, and when the startup sells its assets, the first one that they pay is to the debt holders. So you won't convert the bond to equity shares and be the debt holder for the company and get priority in claims. So don't you think this is a win-win deal for you? Question that should pop up in your mind is, why would a company raise through convertible bonds? Why would a company raise through convertible bonds? Because the company simply needs capital and no one is interested in investing from either equity or debt. Company can come up with something which is very fascinating for an investor, that is convertible bond as an option for raising funds. Comfortable, guys? What is convertible bond? Convertible bond is simply a bond that can be converted into equity shares at a future date. Convertible bonds are simply bonds that can be converted into equity shares at a future date. Fine, shall we move ahead? Then there is perpetual bond. Perpetual bonds are those bonds that keeps you paying the coupon till perpetuity, till forever. Perpetual bonds are those bonds that keeps you paying the coupon forever. You may wonder, how is this possible? And let's try to value a perpetual bond. Basically, bonds and debentures are the terms used interchangeably. Debentures refers to a kind of debt securities that are generally issued only by corporates. So if a bond is issued by corporate, it would be said debenture. What is perpetual bond? Perpetual bond is basically a bond that keeps on paying you coupon forever. So let's say if I am planning to retire and there is my yearly expense are 1 million and the bond is giving me 12% return. What is the amount that I need to invest to serve this $1 million every year till the time I am alive? What is the amount that I need to invest today so that I can, and into the bond which is giving me 12% return, so that I can enjoy the rest of my life with the expense of $1 million? Tell me. You need to evaluate the amount. Let's say that amount is X and 12% of that X should be 1 million. We are not evaluating in face value terms. We are just thinking about that what is the amount that you need to invest. Let's say 12% is the return, YTM, not the face value, not the coupon rate. 12% is the YTM that the bond will give me every year. And that is same as coupon rate. So face value will be, if also guys remember, if coupon rate and YTM is same, face value will be equal to current market price. Also remember this, make a note of this. Now coming to our question, that what amount that I need to invest so that by generating 12% return on it, I get 1 million. What should be that amount? So it would simply be X is equals to 1 million by 12%, which is 8.3 millions. So if you invest 8.3 million today, you will be getting 1 million till perpetuity. Okay. Now, coming to the next type of bonds, that is deferred bonds, deferred coupon bonds. Tell me one thing. Let's suppose I am a real estate developer, and you have a project of 5 years in which the project will be completed. So you need the funding for next 5 years. You need 100 crore rupees for next 5 years. Again, perpetual bond, whether a bond is risk free or whether it is not risk free depends upon the issuer. No bond is risk free. Even the bond issued by government is not risk free. There have been cases like government of Sri Lanka, Zimbabwe, Venezuela, these governments have been defaulted. So no bond is risk free. Although a government like stable government of nations like USA are considered the safest asset class to invest in. Safest asset to invest in. So whether a perpetual bond is risk free or not, it depends on the who has issued that perpetual bond. If a mutual fund house has issued that perpetual bond, you need to evaluate that what is the past of that mutual fund house. If government has issued that perpetual bond, you need to look into macroeconomic factors of the nation, that how the government is expected to perform in future. Okay, coming to deferred coupon bonds, 5 year is the development phase of the project. So those are government bonds that the government guarantees that government will pay you. Government securities are backed by government guarantee that government will pay you back. But what if, I'm not talking about India, I know it's a bit difficult to imagine this in terms of India, but think of a nation like Zimbabwe, a person who has invested in their bonds. If the government has themselves defaulted, or example, a government of Afghanistan, which was taken over by a group of invaders. So if those government has only defaulted, what does the guarantee hold? The guarantee holds nothing. So that is the idea that I'm trying to discuss over here. Everything that is risk free is actually not risk free. There is no guarantee of anything in the market. In practical point of view, anything can happen, right? So we are evaluating the worst possible case scenarios over there. Coming back to deferred coupon bonds, let's say this is in development phase. This 5 years is the development phase for that real estate property. In this 5 years, and from the sixth year, the sale of the property will start. And it is expected to be completed in 6th, 7th, and 8th year. So let's say Suraj Estate Developers is a development corporation which has issued a bond worth rupees 100 million for 8 years. But my dear friends, are these developers generating any cash flow in first 5 years? This is a development phase. Are these developers generating any cash flow in these first 5 years? No, right? So how would be they able to serve coupon? How would be they providing coupon to the investors? So what they do is they issue a deferred coupon bond. What do I mean by a deferred coupon bond? In a deferred coupon bond, the issuers says that for the first 5 years, I am not going to pay you the coupon, but all the coupon that has been accumulated in the first 5 years, I will be paying you at the end of 6th year. So 6th year will include coupon for 6th year plus 1 to 5 years of coupon. So the coupon has been deferred at a later year or at a later date. That is deferred coupon bond. So from 6th year, 7th year, and 8th year, you will be receiving the coupon. And in 8th year, you will be receiving coupon plus face value. Clear? Clear with this, guys? Okay. Next is foreign currency convertible bond. No, it's actually somewhat different to zero coupon bonds. The reason being, they need finances for 8 years. And from 6th year, they have generated good. For 6th year, they have generated good revenues. So they are paying coupons actually in between. So that is the only difference. The coupon is being paid in actually in between. Japan give as loan as in past. Japan give as loan as in past. So what is type of bond? I don't know what you are asking. So WS is saying Japan give as loan as in past. So what is type of bond? See, not every loan that has been given is a bond. Bond is a debt security. Bond is a source of raising debt. But it doesn't mean that if I am taken a home loan, I have purchased a bond or I have given them a bond, right? So loan is not directly correlated to the bond. So WS is saying in Japan, we give money to our government. So are you from Japan, WS? What is your full name? We give money to our government. Wasim, okay. Japan, we give money to our government. Okay. So that may be taxes, right? How can that be a loan, Wasim? Okay, Japan is giving money to our government. Okay, okay, okay. So that is foreign debt, yeah. That is foreign debt. That is so countries like different countries or emerging countries raise debt from different people. So government does not issue generally bonds over there. Government does not issue bonds over there. Those are unsecured. So it's not that if government wants money from someone, they want to issue debt. They could also get money by keeping foreign reserves as collateral. So that is altogether different thing. That is not coming under bonds. That is not under bonds. So a country giving debt to another country has nothing to do with bonds. That is not a type of a bond. Okay. Then there is foreign currency convertible bond. So let's say that I have invested in FCCB, foreign currency convertible bond. So in this case, India is my domestic currency. So rupees is the local currency for India. And let's say I am having option to get coupon in dollars as well. So in a foreign currency convertible bond, I am paying you rupees, and in future I am expected to receive coupon or face value. So here I have a right to convert this bond into a foreign currency. It may be dollar, it may be, or it can be rupee. But if I have an option to convert it in dollar, when will I convert it in dollar? When dollar appreciates with respect to rupees. When will I convert it in rupees? When rupees is expected to appreciate into dollars. So what is there is a convertible option over here that either I can get the money in dollar terms or in rupees terms. Okay, so the coupon and face value can be received in rupees. Also, yes, Nikamni. Also, coming again, just wait a second. Dollar to cent, no, dollar to rupees. So that is one thing. Also, there could be this was one interpretation of it. The other interpretation could be like this way, where I invest in types of bonds. So it depends on the risk that you wish to take. If you want to invest in a very safe asset class, then you can go for treasury bills or government securities or sovereign gold bonds, that is SGB. The return on which is determined by the returns on gold. And if you want to take a bit risk, there are various corporates, various institutions, or various government agencies which will be issuing bonds. You can invest in those bonds as well. Let's suppose I am an Indian citizen and a US body has issued bonds in India. I have paid to the US body in rupees. So I have paid in rupees, I have paid the price. So in future, I am expected to receive coupon as well as face value. I am expected to receive coupon in face value. I have an option over here. Either I could receive this coupon in rupees or either I could choose dollar for receiving this coupon. So this is foreign currency convertible bond. I have an option to convert it into dollars or like get it stayed in rupees. That is foreign currency convertible bonds. Another interpretation can be a foreign citizen invested in a local currency like India, and you are getting a convertible option with this bond. And what is that convertible option? Getting the convertible option is getting equity shares on behalf of these bonds. Getting equity shares on behalf of these bonds. So whether you have an option to convert in two different currencies or whether it is convertible in equity shares, this would be specifically mentioned in the indenture. No, value won't remain same. Value would be different because dollar appreciates or depreciates with respect to rupees, right? So how could the value remain same? If value is 82 rupees per dollar, appreciated from 70 rupees per dollar, you would want the money in dollar in the future year because you are expecting it to rise further. That is why the value is never same. It depends on the currency exchange rates. Last two things for the day now. Last is callable bond and putable bond. Let's say there is a bond which gives YTM of 10% and market rate of similar quality bond went up to 12%. So there was interest rate hike in the market and the interest rate went to 12%. The question is whether price of this bond A will rise or whether the price will fall. My question is whether the price will rise or whether the price will fall. Think about it for a second and let me know. Okay, GA is saying price will fall. If you are getting 10% from the bond that you earlier invested in and similar such bond gives you 12%, would you want 10% or 12% return? Would you want 10% return or 12% return? So everyone will be selling this bond and buying this bond. Since everyone is selling this bond, what happens when supply rise? When supply rise, prices fall. Since everyone is selling it, the prices would fall. And logically, let's say if YTM has increased, if the YTM is 12%, don't you think interest rates are inversely proportional to bond prices? Because the higher the rate of return, the higher the YTM, lower the bond price. Try to do this as an exercise on your home. Consider this as a homework. Consider a bond with same face value, 1,000, with coupon rate 10%, NPER 3 years and annual coupon payment. And YTM is, take three scenarios. YTM has 8%, 10%, and 12%. Try to find the price. You will see as you keep on increasing the YTM, when you keep on increasing the YTM, the prices of the bond will keep on falling. This shows you that the interest rates are inversely related to the prices of the bond. Do you guys agree to this? That interest rates are inversely related to prices of the bond? Agree to this? Based on the same concept, there are two types of bonds, callable bonds and puttable bonds, that we will be seeing in next class. Yes, central bank interest rate affects the interest rate of overall market. Not central bank interest rate not only affects the interest rate that the money that it lends to the bank, but also affects the interest rate of overall bond market. Here we are talking about market interest rate that is actually determined by central bank. Okay, so based on that concept, we will be looking to callable bonds and puttable bonds. I would have extended this, but there are two major reasons that we are not doing so. Some of you guys are, and even me, are very curious about the India versus Pakistan match. And also, I am not left with more slides. So we get only 20 slides in Zoom app, and I am done with all the slides. So let me share this sheet to you. Just a second, the sheet is being shared. Okay. Match is not started yet. Still it is raining there. Okay, PJ has started working on the homework part. She says at 8%, 1051 is the return. At 10%, 1000 is the return. And at 12%, probably less than 1000, which proves the point that as you keep on increasing the interest rates, bond prices keeps on falling. So you can see that there are 20 slides in the sheet that I have shared, and we cannot add more slides. I will have to delete all the sheets and then start again. It would extend a session for a much longer time. So no worries, we will be concluding fixed income securities in the next class. If the bond is paying more interest rate, bond does not pay coupon interest rate, bond pay coupon rate. And interest rate we are talking about relates to the YTM, yield to maturity. So interest rate is always yield to maturity. And what will be the next module? It would be asset management and mutual funds. 1, 2, 2, 3 will be done by next week. Last two classes left for 1, 2, 2, 3. IB 1, 2, 2, 3. KG interest rate is YTM, bond pays coupon rate, and you see here coupon rate is not changing, but YTM, that is the interest rate that you need, the return that is why the bond prices has to fall to incorporate the greater return that you want. Okay, so that was all from my side, guys. I hope you enjoyed the session. So yeah, the screen is not shared. I have posted the sheet, the scribbled sheet in the chat box. It would be uploaded on the LMS as well. Don't worry, KG, if you are not getting it. That is something we are going to revise in the next class as well. We will be starting the next class with that particular point, so you will be comfortable with that. So there are various other sessions that will be conducted, Veera. For that, there are mock interview session, there are LinkedIn optimization session and career guidance session. Those are being taken with some other people who are well professional and expert in all those areas. So although these sessions are scheduled for you, they will be taken by some other people. Okay. So bye bye guys. Take care. Have fun. Enjoy your day.